Good morning, everybody, and thank you for joining us for this morning's Guaranteed Loan Servicing Refresher webinar. My name's Matt Henderson. I'm a Senior Loan Officer with FSA's National Office, and I'm going to be your MC or your host here today. With me as well, I have Lisa Liska, who is a Senior Loan Officer with FSA's Guaranteed Loan Servicing branch, and Lisa is actually going to be providing the majority of today's content to you. So you'll be hearing from her in a few minutes once we get things kicked off. And additionally, we have Heather Lubenthal with us, who's behind the scenes helping produce the event and will also help us moderate the Q&A as well. So before we get started, we do have a couple housekeeping things to go over with you. This is a Microsoft Teams live event. So for those of you who are not familiar with these, it is a one-way broadcast, which means that as a participant, you cannot share your audio or video feed with us. But we do encourage you to ask questions, and the best way you can do that is to utilize the Q&A feature here within Teams. So the way you can access that is to somewhere toward the top of your screen, you should see a little Q&A icon. And if you click on that, it should open a little window on the side of your screen where you can submit a question to us at any point throughout the presentation. We do have some time set aside at the end to address as many questions as we can as time allows. This session is also being recorded. For those of you who have attended some of our past webinars, as you know, we make it a point to post the recording and a copy of the slides and a Q&A document. So we're going to follow suit and do the same here. Those will be stored on our Guaranteed Lender Toolkit page, which is the same location where those have been stored for the prior webinars. And there should be a link to that in the Q&A as well, in the Q&A feature here, where you can go ahead and grab that hyperlink to that page if you don't have it already. Additionally, if you or anybody on your team needs closed captioning, that feature is available through Teams as well. If you just click on the three dots or the ellipsis toward the top of your screen, that should open up a menu with some different options, including closed captioning if you do need that. So before we get into Lisa's great content on guaranteed loan servicing, there was just, I did want to spend a couple minutes visiting with you about the Enhancing Program Access and Delivery for Farm Loans rule, which is quite a mouthful, which is why we've taken to calling it the Enhancing FLP rule for short. Hopefully most of you have heard about this and are aware of this by now, but like I said, we did just want to spend a couple minutes reminding you about a few things regarding that this morning. So this was a rule that was published in the Federal Register back in August, but the changes in the rule actually did not become effective until September 25th. So they've only been in effect for approximately 3 weeks. The rule was open for public comment, but that public comment period closed on the 7th. So about a week and a half ago or so, the public comment period closed. And like you can see here on the slide, the rule contained quite a few changes, over 40 different changes, clarifications, etc. And we're not going to go through all those here today, but I did want to revisit just a couple key things from the rule that might be of interest to our lenders. And also, you should be aware that back in August, shortly after the rule was published, we did conduct a briefing for our lending partners to go through some of these changes in more detail. So hopefully you were able to attend that at the time. But if you weren't, again, that recording is available on our Lender Toolkit page. So definitely would suggest that you go check that out for some more detailed information if you didn't catch that the first time through. So a few specific changes to the guaranteed program we just wanted to remind you of is that we did expand some opportunities as it relates to subordinations for guaranteed loans. More specifically, lenders can now get a subordination to refinance their own debt, which was not an option before. Additionally, it used to be required that if you were restructuring a guaranteed loan and that included a balloon installment, you were required to take a lien on all of the borrower's assets. That requirement to take a lien on all their assets is no longer required in that scenario. Obviously, we still have to make sure the loan's secured, but in a restructure like that, you'd no longer be required to take a lien on everything. And additionally, we made some clarifications around the transfer and assumption process, and mainly just clarified that regardless of lender status, all lenders do need to come to FSA for concurrence on a transfer and assumption, primarily just to make sure that the new borrower does indeed meet FSA's eligibility requirements. Now, outside of those changes, there were a few other pretty notable changes, pretty major changes in the rule, and they primarily affected our direct loan program. but we did just want to remind you of them again because you may hear FSA staff talking about them, or you may run across some of these things as you're working with FSA in joint financing scenarios. So again, we just wanted to touch on them here briefly. The first thing was we created a distressed borrower set-aside program. And just to be clear, this is that program is only available for direct loans. It is not available for guaranteed loans. But anyway, the way the program works, it's basically a short-term, relatively quick way to alleviate some financial stress for a direct loan borrower. And basically what it allows them to do is set aside their next installment and basically just push it off till the end of the loan. And that portion that's being set aside only will accrue interest at 1/8 of 1%. So obviously in the near term, it helps the borrower alleviate some of that financial distress, but then also makes things a little less difficult when they go to pay that set aside installment at the end, because it will not have accrued as much interest. So again, that's only available for our direct loan program, but again, you may run into that or hear about that as you're working with some of our mutual customers. Similarly, we also made some changes to our direct loan collateral requirements. And again, for the sake of time today, I'm not going to get into the weeds on that, but suffice it to say, for our direct loans, we're not going to be taking quite as much security moving forward as what we did in the past. Now, that being said, our direct loans still have to be fully secured. So they're still going to be secured like they always were. It's just we're not going to be taking as much additional security as what we had in the past. And really where that's hopefully going to be beneficial to our lenders, particularly, is when you're trying to work with a customer who also has an FSA direct loan. Because of these changes, hopefully that should mean there's some more assets available to potentially serve as collateral for a loan from a commercial lender, because we won't have quite as many assets tied up with our direct loan. And then finally, we did make some changes as it relates to our direct loan repayment terms as well. And again, since this isn't the primary topic of today's session, I'm just going to keep it pretty high level. But suffice it to say, with our direct loan repayment terms, we're really trying to emphasize that we want to give the borrower the opportunity to accumulate a reasonable amount of savings for things like education, retirement, et cetera, just to give them opportunity to make progress towards some of those long-term goals, which I think is obviously a goal we share with our commercial lending partners. So what you're going to see moving forward with some of our direct loans is probably some repayment structures that are a little more flexible than what you're used to seeing, and maybe a little more flexible than what you're typically able to offer with a commercial loan, as far as interest-only options, things like that. But a lot of the reason I bring this up is because our guaranteed lenders may be wondering, does this mean that we're going to have to offer the exact same rates and terms and repayment schedules as what FSA is going to offer for direct loans? And the short answer there is no. Really, when it comes to our guaranteed loans, what we just want to make sure is that the rates and terms, how that loan is structured, that it just sets the borrower up in a way where they can make progress toward those long-term goals and accumulate a little bit of savings. And really, when you stop and think about it, you guys really already do this today anyway, because obviously, your underwriting requirements already typically require a little more of a margin or a cushion there in the cash flow anyway, than what we'll sometimes accept for a direct loan. So point is, you guys are kind of really already doing that, and when we look at a scenario like that, it should be pretty easy to see that there's some margin there that is available to the borrower to put back in the operation, or like I said, put a little more away in a retirement account or a education fund, whatever the case may be. So, really, we don't see that the changes we're making on the direct loan side here, we really don't see that changing the dynamic of our relationship with our lenders, or anything like that. If anything, we actually see it strengthening that relationship, because really it's just another way that we can make sure we're partnering together to set our borrowers up for the best chance of success, which is obviously a goal that we collectively share. So I do appreciate being able to take a couple minutes here this morning just to remind you of those things. Like I said, if you're interested in learning some more specifics about each one of these things, I definitely would encourage you to go check out that recording from our briefing back in August. It has a lot of great information in there for you. And then also, obviously, as you're working with FSA just on different joint financing cases and whatnot moving forward, obviously, like any case-by-case type situation, there'll be plenty of opportunities to ask questions and get more information if anything's unclear. So With that, we're actually going to go ahead and pivot now and focus on the primary topic for today's session, which is guaranteed loan servicing. So with that, Lisa, the floor is all yours.
All right, thank you, Matt. Good morning, everyone, and welcome to our Guaranteed Loan Servicing Refresher webinar. We're going to cover several topics this morning, hopefully to give you a little background or a reminder on options that are available to you and your customers if you're dealing with someone who is financially distressed or delinquent. So we just kind of wanted to refresh everyone on those and give you some updates along the way. So some of those topics that we're going to cover today, first we'll go through the lender roles and responsibilities of maintaining a guarantee. That's going to include supervision of the borrower, supervision of the collateral, and annual analysis requirements. Also touching on how to service a delinquent guaranteed loan, what your reporting requirements are to FSA when someone becomes delinquent, and then again considering those debt servicing options that are available for you to use on guaranteed loans. And then lastly, we'll touch on a couple of other tools out there, emergency advances and protective advances, and we'll talk about the difference between the two. So first, we'll dive into our lender roles and responsibilities of maintaining a guaranteed loan. First, as a guaranteed lender, you do have some responsibilities in maintaining that guaranteed loan. Those are going to include servicing the entire loan in a reasonable and prudent manner, protecting and accounting for collateral, and remaining the mortgagee or secured party of record. So specifically, your responsibilities are going to be servicing that guaranteed loan as you would service any other loan in your portfolio. We don't want you treating a guaranteed loan customer differently than your other customers. And then more specifically, complying with all of FSA program requirements. So some specific items when supervising your borrowers that you need to be aware of. Make sure that the loan funds are not used for unauthorized purposes. So for example, if you are administering a guaranteed line of credit to your customer, you want to make sure that you're monitoring that loan to ensure that none of the advances are for unauthorized purposes, such as, maybe you advance for a down payment on real estate with a guaranteed line of credit when that's not an authorized purpose. You want to make sure that that loan is specifically used for annual operating expenses. Another item is borrower in compliance with provisions in the promissory note and security instruments, so make sure that they're adhering to all those. Also, that the borrower remains in compliance with all the laws and regulations that are applicable to the loan, collateral, and operations of the farm, and again, specifically laws in your state as well. When looking at receiving payments, make sure that you receive all the payments of principal and interest on the loan as they fall due and promptly dispersing to any holder its pro rata share if that's applicable. One other thing to note here with payments is that when they're received, they must be applied to debt upon receipt and they can't be held in escrow until the payment is due. So when you receive payment, make sure you apply it to the loan promptly. And lastly, perform annual analysis. And we're going to dive in a little deeper on annual analysis requirements and what is required of you to submit to FSA here shortly. So specifically with application of payment, a couple other things to note. When you receive a payment from the sale of encumbered property, such as you have a lien on the property and it was pledged as security, those loan installments will be paid in the order of lien priority. And if you're receiving a payment that's from the sale of unencumbered property, meaning you didn't have a lien on it, but maybe the borrower owned that already, or other sources of income, then the loan installments will be paid in the order of their due date. When it comes to maintaining your guarantee, you also need to service the collateral. And these are a few of the items that we are specifically going to look at when we come to do lender reviews as well. So obtain income and insurance assignments when required. So whatever was established in the loan conditions and loan closing requirements by FSA, we're going to make sure that you're maintaining those through the life of the loan. So for example, you have an assignment of rent when it's applicable, assignment of indemnity on crops, or that you're listed as lost payee on equipment or any real estate improvements. Also, you need to ensure that the borrower has or obtains marketable title to the collateral. You also should be inspecting the collateral as often as deemed necessary to properly service the loan. So that can vary depending on the status of your whether you're SEL or CLP or PLP. Mostly, you're looking at that probably yearly or maybe a little less often if that happens to be real estate only. Make sure to ensure the borrower does not convert loan security. So make sure you're tracking that collateral, and if it's being sold, you're applying payments as you should, or replacing that collateral. And that kind of leads into the next one. Ensure proceeds from sale or other disposition of collateral are accounted for and applied. This is where if they sell it and they don't plan on replacing it, make sure it gets applied to the loan, or if they need to replace that item, it's used to purchase that replacement collateral. Some additional items with servicing collateral: ensure that the loan and collateral are protected in the event of foreclosure, bankruptcy. Make sure that if there is any litigation, one of the things you're doing is protecting that collateral. Be sure to also stay in communication with us at the local level when your guaranteed borrower gets into these situations so that we can help navigate that with you. Also, ensure taxes, assessments, or ground rents against or affecting the collateral are paid. I'm going to make sure that those are always paid timely. Also, ensure adequate insurance is maintained. And that was probably, again, established as a closing requirement or condition of the loan. So make sure that you're maintaining it at what was required at loan closing. This is going to be, possibly at replacement costs for machinery and equipment or improvements on real estate like buildings or pivots. Also, ensure that insurance loss payments or similar proceeds are applied on debts in accordance with lien priorities, or they can choose to use those proceeds to rebuild or acquire that needed replacement collateral. I mentioned before that one of the supervisions required annual analysis. So here we're going to dive in a little deeper on analysis of the borrower's financial conditions. First, the lender must perform an annual financial analysis of the borrower's operation within 90 calendar days of the end of the borrower's operating cycle. One thing I also want to remind everyone of is previously we did have some COVID-19 emergency flexibilities that allowed you to complete annual analysis and maintain that in your file. Those flexibilities have ended, and so what we're going to go over here today is for the specific lender statuses and what you need to submit. That is resuming, and we will be following what is in the 2FLP handbook. An annual analysis is required for all borrowers with term loans greater than $100,000 and on all line of credit loans. And then also for borrowers with an outstanding loan balance for existing term loans of $100,000 or less, that need for an annual analysis will be determined by the agency. And what is that going to include? So we have specifically here what's going to be the indicators for you to conduct an analysis when it's below it's at 100,000 or less is if the loan is past due by more than 30 days. A current balance sheet indicates financial deterioration, including a reduction in collateral and or values. And if the credit report indicates an increase in use of credit, increase in late payments, or you see an increase in collection activity that results in the decrease of the credit score, that would be another indicator of us wanting you to conduct an analysis on those outstanding loan balances of 100,000 or less. So now more specifically, what does each type of lender need to do for an analysis and what are you required to submit to FSA? So if you are a standard eligible lender or a micro lender program, those are going to include borrower's balance sheet and income expense statement from the previous year, if it's applicable, depending on the term and collateral for the loan. For line of credits, the cash flow for the borrower's operation that projects a feasible plan or better for the upcoming cycle. And one thing to specifically note here is if you're a standard eligible lender, you must receive approval from the agency before advancing for the future year funds on a guaranteed line of credit. Also, an annual farm visit or collateral inspection. And then lastly, a narrative summary of the borrower's financial progress, again, if it's applicable, depending on the type of loan or the collateral for the loan. So we have a nice submission summary here in this table, and we want to make sure that these documents are submitted within 30 calendar days of completion. Next, if you are a certified lender program, so CLP, the documents that we're going to be looking for here are going to be a written summary of the lender's analysis of the borrower's operation. So that summary could include a description of the borrower's progress, whether an analysis was waived or postponed, if the borrower is financially strong, or other reasons for why the analysis was not necessary. And again, that's going to be dependent on the term or the collateral for the loan. And then for the guaranteed line of credits, you're going to need to provide an annual certification to FSA stating that the cash flow is projecting at least a feasible plan and has been developed for that borrower in compliance with provisions of the loan, and that the previous year's income and expense, loan funds, and security proceeds have been accounted for. So, and then again, we have that summary of those items to be submitted here, and these documents should be submitted within 30 calendar days of completion. And lastly, if you're a preferred lender program, PLP, you're going to perform an annual analysis in accordance with your lender's agreement and credit management system, or CMS. Every PLP lender has their own CMS and own established analysis requirements that you will need to document in your borrower file. You do not need to submit an annual analysis to FSA for review, but rather maintain it in the file, and most likely that will be reviewed at the time that FSA comes and conducts a file review. Okay, the next topic we're going to discuss is how to service a delinquent guaranteed loan. So first, we're going to dive into a timeline about the delinquent loan servicing. What are the steps you need to take at certain times in that timeline? So when the payment due date is 30 calendar days past due, that is when we consider the borrower in default. And within 45 calendar days after due date, that's when we expect that you've met with the borrower and you've had a meeting to hopefully discuss some ways to navigate that delinquency, possibly discuss servicing options to hopefully cure the delinquency. At 60 calendar days, that's the absolute earliest date that a lender can initiate foreclosure action if you can't come to a way to cure the delinquency. And then within 120 calendar days after due date, that's when we expect you to implement a loan restructuring plan to hopefully cure the delinquency, or if not, that's when the decision is made to liquidate. One thing to emphasize again, a borrower is considered in default when they're 30 days past due on the payment, or if they're in violation of provisions of the loan documents. So there can be the instances of non-monetary default. And when a default occurs, the lender is expected to work with the borrower so that the loan can be brought current and the borrower can continue the operation. So again, more specifically, when the lender, we cannot initiate foreclosure action on a loan until that loan is at least 60 days past due. Also, you have to determine if eligibility of the borrower to participate in interest assistance program. I wanted to just point this out specifically because currently FSA does not have interest assistance funds available. So therefore, you're just going to document on the default status report, which is form FSA 2248. And in the borrower's case file, the interest assistance was considered, but that funding is not available at this time. And so that's just a step that you need to consider at the time when the borrower becomes 60 days past due and document that accordingly. Some of the things that you need to continue to do while the loan is delinquent is submit a guaranteed farm loan default status report. Again, that's form FSA 2248. You're going to submit that once the loan becomes delinquent, which is at that 30-day mark, and then every 60 calendar days thereafter until the default is cured or until the payment of a final loss claim. Also, you need to decide whether to restructure or liquidate an account within 90 days of default or 120 days after payment due date. Again, some things to know: make sure that you're promptly following up on your delinquent payment customers. Early recognition is really important. It helps you solve those loan problems, and also considering the prudent use of restructuring tools. Those are keys in resolving any delinquent loans. Along with that, I wanted to bring up some of the general reporting requirements as a guaranteed lender that you're expected to do while you're maintaining a guarantee. The first is submitting a guaranteed farm loan status report, which is form FSA 2241. That you need to submit, all lenders need to submit March 31st and September 30th of each year. You can do that manually by submitting the form, or if you have an account set up through Link, you can submit it electronically. The most recent one was just required here on September 30th. So make sure that you are getting those completed here timely right now if you haven't done so already. And as I mentioned before, the other reporting form is FSA 2248, Guaranteed Loan Borrower Default Status Report. This is what you're going to submit once the loan becomes delinquent, which is 30 days after the due date, and resubmit every 60 days thereafter until the default is cured or until the payment of a final loss claim. And then the last reporting form is 2261, Report on Collection Activities on Liquidated Accounts. This is only going to be in the instance where you're following up after a final loss claim payment has been made. All lenders will need to submit this annually for 3 years following that final loss claim on any collection activities that you have thereafter. Okay, I mentioned briefly about restructuring tools and things that we want you to consider when your customer becomes delinquent. So let's dive into what those options are, and hopefully some of these are things that you can consider if you have any customers that become financially distressed or delinquent this coming loan season. First is the restructuring or rescheduling of debt. This involves changing the payment terms of a loan, such as a change in the term and years of a note or a line of credit agreement. Another option to consider is deferrals. This is where you postpone the payment of principal and interest to accommodate a temporary inability of the borrower to make scheduled payments. And then the last option to consider if rescheduling or deferrals does not result in a feasible plan is debt write-down. This is probably the least used. This involves writing off a portion of the outstanding balance of a loan, and all lenders must seek FSA concurrence before they execute a debt write-down. So let's talk more specifically about rescheduling of debt. Payments will be rescheduled with the following terms. So depending on the type of loan, these are the parameters you need to follow. If it's a guaranteed FO, it may be amortized over the remaining term of the loan or rescheduled with an uneven payment schedule over a period not to exceed 40 years from the date of the original note. If it is a term operating loan, they may be rescheduled over a period not to exceed 15 years from the date of the rescheduling. And with any of these options, you can always go lesser. It's just you can't exceed 15 years for an OL or 40 years on an FO from that original note date on an FO. And then if it's a guaranteed line of credit, loans can be rescheduled over a period not to exceed 7 years from the date of the rescheduling or 10 years from the date of the original note, whichever is less. So keep that in mind, that when you have to pick whichever is less. And then once a guaranteed line of credit is rescheduled, advances can no longer be made against a line of credit. And so it then becomes a term loan. When rescheduling debt, a new note is not necessary. However, a new note is, if it's not taken, the existing note or line of credit agreement must be modified. You can attach an allonge or any other legally effective amendment, and that would evidence the revised repayment schedule or any interest rate change. Also, the interest rate for rescheduled loans, that is negotiated between you and the borrower. And just like at loan making, we want to make sure that that meets our maximum interest rate requirements that are established in our 2FLP handbook. And then lastly, you can capitalize the outstanding accrued interest when restructuring. There are some parameters to consider with that. As a result of capitalizing interest, the rescheduled promissory note may increase the amount of principal the borrower is required to pay. However, in no case will such principal amount exceed the statutory loan limits. Now, when accrued interest causes the loan amount to exceed the statutory loan limits, rescheduling can still be approved without capitalizing the amount that exceeds the limit. And then late payment fees and default interest penalties, they are not allowed to be capitalized and they're not covered under the guarantee. Now, if you're considering restructuring, there are some conditions that apply. The borrower does need to meet the general FSA eligibility criteria, just as they would for loan making, except the provisions regarding prior debt forgiveness and delinquency on a federal debt. Those do not apply at the time of restructuring. And then the documents that you need to complete if you are an SEL or CLP lender, those are going to include a feasible cash flow plan, a current financial statement from all liable parties, verification of non-farm income, collection of verification of all debts if they're over $5,000, any applicable credit reports, financial history for the past 3 years, and if you're SEL, also production history for the past 3 years. And then if you're a PLP lender, you're going to refer to your CMS for the proper documentation for rescheduling of debt. For any restructuring action, the following conditions do apply. Loans restructured by real estate, equipment, or breeding livestock can be restructured using a balloon payment. The borrower, like we discussed earlier, the lender, as we discussed earlier, may capitalize the outstanding interest. If a borrower is current but unable to make the upcoming scheduled payment, a restructure proposal may be submitted prior to that payment coming due. So this is a case where, trying to get ahead of a situation, if you know your customer is already financially distressed, you can go ahead and take a look at restructuring options and present those before they become delinquent. Also, the lender's security position will not be adversely affected because of the restructuring. And the last condition, that any holder agrees to any changes in the original loan terms if that guarantee had been sold on the secondary market. The next tool to consider is deferrals. Deferrals are payments that may be deferred up to 5 years, but the loan may not be exceeded beyond the final due date of the note. So one thing to note here is if a line of credit deferral exceeds 1 year, then the line of credit must be restructured and no new advances can be made. Also, the principal portion of the payment may be deferred either in whole or part, and then the interest may be deferred only in part. And lastly, but most importantly, there must be a reasonable prospect that the borrower will be able to resume full payments at the end of the deferral period when considering that. With deferrals, the amount of principal and interest deferred must be based on the borrower's current ability to pay and the projections about ability to pay in the future. So if the deferral period is to extend beyond 1 year, only a portion of interest can be deferred. Following deferrals, if your customer still remains financially distressed and unable to make a payment, the loan could then be rescheduled after deferral. So you could go back and consider rescheduling options if the deferral was unsuccessful. So how do you go about requesting a deferral? To request a deferral, SEL lenders, you're going to submit the same documentation that we discussed under restructuring. For CLP lenders, you're just going to provide a certification to FSA that the requirements have been met with a narrative outlining those circumstances surrounding the need for deferral, along with any copies of applicable calculations and copies of any restructured notes or line of credit agreements or allonges. And then PLP lenders, again, you're going to refer to your CMS and provide documentation upon completion. And now the last option, and this option should only be considered after the guaranteed loan cannot be brought current with restructuring of debt or deferral, and that's debt write-down. A lender may only write down debt on a delinquent guarantee loan or a line of credit in an amount that's sufficient to permit the borrower develop a feasible plan of operation. Also, the lender will request other creditors to negotiate their debts before a write-down is considered. The borrower cannot develop a feasible plan after consideration is given to restructuring and deferral, as I noted when we first looked at this slide. And lastly, the present value of the loan to be written down based on the interest rate of the rescheduled loan will be equal to or exceed the net recovery value of the loan collateral. Some more specifics regarding debt write-down. The loan will be restructured with regular payments at terms no shorter than 5 years for a line of credit and for OL term loans, and no shorter than 20 years for farm ownership loans. And so make sure to note that no shorter than 5 years for a line of credit and OL, and no shorter than 20 years for an FO. Once a debt write-down is conducted, no further advances may be made on a line of credit that is written down. Also, loans may not be written down with interest assistance, and the write-down is based on writing down the shorter term loans first. When requesting the approval of a write-down for a borrower with multiple loans, make sure the security for all the loans is cross-collateralized and continues to serve as security for that loan that is written down. Also, the write-down will be evidenced by an allonge or an amendment to the existing note or line of credit reflecting that write-down. So those are the details regarding our different restructuring, deferral, and write-down options when your customer becomes delinquent. And then the last topic I want to cover today are some other tools in the toolbox, and that is emergency advances and protective advances, and the difference between the two depending on what kind of situation your customer might be in. So first, let's talk about issuing an emergency advance, and this can only be done on our guaranteed line of credits. In cases of a guaranteed line of credit, lenders may make an emergency advance when a line of credit has reached its ceiling. The emergency advance will be made as an advance under the line of credit and not as a separate note. Also, an emergency advance in excess of the original loan amount is made with when some deviation causes expenses to exceed the original budgeted amount and is necessary to avoid significant damage to or loss of the security. So what's an example of an emergency advance? Where I currently live, it's been very dry this harvest season. So for example, we've seen some equipment get caught on fire and destroy the combine during this prime harvest season. So it's necessary at that point for the customer to possibly rent a combine to get the crop out of the field or custom hire. And that was a budgeted item that was not included in the cash flow and is necessary to avoid damage to the rest of the crops. So that would be an instance where you could do an emergency advance for that cost of, say, renting a combine or custom hiring to complete the harvest timely if they've already exceeded their original loan amount. Also, on emergency advance, it shall not be used if its use will cause the total amount of the borrower's debt to exceed the statutory loan limit. So make sure you keep that in mind and consider all the outstanding debt of any other guaranteed loans. Another thing with emergency advances, the lender's loan documents must contain sufficient language to provide that any emergency advance will constitute a debt of the borrower to the lender and will be secured by the security instrument. So the following conditions do apply. First, the loan funds to be advanced are for authorized operating loan purposes. So a big thing to note here is an emergency advance may not be used to pay for, say, carryover on an existing line of credit or for annual operating expenses for the subsequent year. So it has to be for authorized annual operating expenses. Number two, the financial benefit to the lender and the government from the advance will exceed the amount of the advance. That's important to note because there may be an instance where you need to do an advance and you've put together a cash flow and it may not have a feasible margin. Perhaps it's slightly negative. However, the financial benefit from the emergency advance must exceed the amount of the advance, and that might be a way to help your customer. And then lastly, the loss of crops or livestock is imminent unless the advance is made. So be sure to keep those three conditions in mind when considering an emergency advance. And then how do you go about getting permission to do that? If you are an SEL or CLP lender, you need to obtain written permission from the agency before any emergency advance on a guaranteed line of credit can be made. And if you are a PLP lender, again, you're going to refer to your lender's agreement and CMS and follow that in and the guidance provided in there when you're doing an emergency advance. All right, another tool is protective advances. This is a little different because protective advances can only be used when the borrower is in liquidation or liquidation is imminent. So what are protective advances? They're expenses incurred by a lender to protect or preserve the collateral from loss or deterioration. And like I just mentioned, they are used only when the borrower is in liquidation, liquidation is imminent, or when the lender has taken title to real property in a liquidation action. An example might be the borrower's in liquidation and the security includes buildings on real estate where the insurance is about to lapse. So it's necessary for you to consider a protected advance because you need to maintain that insurance policy in order to protect the collateral, say in the event of a fire or natural disaster. So doing a protected advance in that instance would be an appropriate time. Protected advances may only be made when the lender can demonstrate the advance is in the best interest of the lender and the government. So also keep that in mind as a criteria. And how to go about asking for concurrence. Prior written authorization from the agency is required for all protective advances in excess of $5,000 for CLP lenders and $3,000 for SEL. And then the dollar amount of protected advances for PLP lenders, again, that's specified in your lender's agreement and CMS, so you're going to need to reference that. If you did not specify a certain dollar amount in your CMS, then you're only going to be allowed up to $5,000, and then you'll need to ask for FSA's written authorization for those advances in excess of $5,000. So if your CMS does not contain specific guidance. So those are the requirements required in getting written authorization for protective advances. Okay, with that, that concludes all the topics we wanted to cover today regarding guaranteed loan servicing and hopefully refreshing you on some of those options that are available out there and how to work with your customer when they become delinquent. And with that, if you have any questions, be sure to put them over in the chat. And Heather, do we have anything in there that we can address right now?
We do.
Okay.
All right. So the first question, how do we handle annual reviews when a borrower will not do a farm visit or submit financials, but is otherwise performing?
Okay. So that can become difficult because that's a condition of the loan that they should be following. You know, there's obviously we want you to work with the customer and try to conduct farm visits so that you can ensure that the collateral is still being maintained and in good condition. I think, Tim, are you responding to that one right now, or maybe you have?
Yeah,
I didn't want to.
Yeah,
I didn't want to give a different answer because I can't see it, unfortunately, on the screen. But did you have something further to add on that?
yeah. I think just pretty much what you said, and then I think the main thing that you need to do is make sure that you are documenting in your file that you're attempting to obtain the financials, you're obtaining or trying to do your farm visits. You may consider doing drive-by inspections. You just want to make sure you're documenting that as good as you can through running records or photos, things like that. If you're having to do drive-by inspections to look at the security, and then I guess depending on the case and how bad it might be, you may consider taking actions to notify the borrower of either being in non-compliance or non-monetary default. So every situation is a little different. I guess I would just say, make sure you're documenting everything that you're doing with regards to those concerns.
When a status report is filled out and states it's behind, but they are within 30 days past due and will be brought current within the 30 days, do lenders need to submit the FSA 2248 to state that they are now current to change the status in GLS?
Yeah, so if you've reported that the customer is behind, if they do become current, you will always submit an FSA 2248 to provide that. That way the status that we're maintaining in GLS then reflects them as current. So yes, you'll do a 2248 to tell us that while they're delinquent during that time frame, and then also your last one will indicate when they become current if you were able to cure the debt with them. Cure the delinquency, I'm sorry, with them.
Okay. Verification of debts. It has become increasingly difficult to collect a verification of debt from dealer financed equipment. For example, John Deere, CNH Finance. How do we deal with not being able to verify debt from these lenders?
What I would suggest in those situations, if it's not on the credit report and you're having difficulty obtaining it from the creditor, another option is to ask your borrower. These days, borrowers can look up that information right on their cell phone and pull up the account. So you can always ask the customer to bring up that account balance and email it to you or print a copy off, and that would suffice as verification as well.
I'm in the process of applying for an emergency advance of additional funds. I've supplied the office with the documentation required. What is the time frame of hearing back from the FSA office?
An emergency advance. And I need to double check real quick. Do you know off the top of your head, Tim?
I don't. I believe it's 14 days.
I think it's 14, but I was just gonna double check. I think I have that handy here. We don't have a specific timeline actually established in our handbook, but yeah, we just say that we should make every effort to respond to requests for an emergency advance within several days of receiving the lender's request. So hopefully that office is just taking, you know, not too long and trying to prioritize that and not taking too long. But, you know, if it's taking a couple of weeks, be sure to follow up with them and continue to communicate with that local county office, or if you need to contact the state office to discuss as well. But we don't have a specific requirement. We just say that we like to address it within several days of receiving your request.
Yet another question on emergency advances. Do all three conditions need to be met for an emergency advance?
So those are, it's not a and they're just all the conditions apply. So yeah, they need to be for authorized purposes. It needs to be for the financial benefit of us and the lender, and there needs to be, you know, a loss of crops or livestock is imminent. So all three of those conditions do apply and need to be met, if those are the ones they're referring to, I believe.
The best discounts on crop inputs are offered before all crops are grown the prior year and sold, and the operating line of credit is not totally paid down. How should these advances be handled?
So I'm assuming they're talking about on a guaranteed line of credit.
Yep.
Perhaps you're an SEL lender and you're thinking, well, I need to get concurrence from FSA before I advance for the next operating cycle. Totally understand that, you know, you want to look for those discounts ahead of time. So you may need to conduct an analysis a little sooner. The other thing is, you know, the line of credit does not have to be paid down to zero before you could consider advancing for the next operating cycle, but you do need to have a current balance sheet compiled that shows that the current assets available are going to be able to pay the current liabilities, meaning is this year's crop going to cover all of the advances that you made thus far for the 2024 operating cycle? So if you have documentation that shows that that can be paid to zero, then you'll want to compile that, and that would be sufficient documentation to show that you can then advance for the next operating cycle. And if you're SEL, make sure you're getting that concurrence from FSA before advancing.
This next question, I think what they're getting at is, it says, when the loan is made, can they quit claim to the LLC? I'm assuming they made the loan to a person or a personal, an individual, and then they want to quit claim the loan to the LLC. But I don't have, if the person who asked that could add a little more context, that might give us a little better information.
Really good. Yeah, it's going to really depend on the situation. So we might need some more details on that to be able to give you an answer.
In the case of workouts where no loss is expected, how do PLP lenders properly notify their local FSA office, and what documentation is needed?
With PLP lenders, again, a lot of that's going to be dictated on what was established in your CMS. Your general reporting, you are still expected to submit the default status reports timely, your semi-annual status timely, so we know what's going on in the event of a delinquency. But if there's no loss expected, you're just submitting the default status report and writing in the comments to let us know what's happening. I'm assuming that's what the person is getting at in that situation, because you're maybe doing a workout plan that's some type of rescheduling option.
We would maybe even also encourage them to submit the estimated loss claim as a zero.
Yes.
Within the 150 days. And the reason for that is, there are cases where it ends up being a loss. And then if they don't submit the loss claim showing a zero, loss, then we are still limited to how much accrued interest we can pay if there is actually a loss to 150 days. So we would want them to probably submit that to cover that area, and then probably a liquidation plan would also be necessary, because that would give us an idea of where the borrower is.
Okay, this one might be loan making and loan servicing. Weigh in on this one. If the conditions of the loan are not met, is the guarantee terminated? Matt Henderson, you want to weigh in on this one?
Sure, I can take a stab at it. I mean, really, with a question like this, it's kind of always going to be a case by case type situation to see really what condition wasn't met. Excuse me, what condition wasn't met. Whether or not there was a loss. Did the fact that condition wasn't met, did it contribute to a loss or not? It's just one of those where, I mean, obviously, anytime a condition of the loan's not met or a condition of the guarantee is not met, it's something to, that we need to take a look at. But, the ultimate implications of that is just really going to vary depending on the specific situation.
Yeah, I would say if the conditions of the loan aren't met, that's more of possibly the borrower not being in compliance, not so much considering the guarantee terminated. And it's just going to vary depending on what that is.
Under the protected advance of a quit claim, is the borrower notified? We might need some more information on that one. Clarification.
But typically, the lender is FSA's customer, so we are going to typically, when any kind of correspondence is going to go to the lender, not to the borrower. So I guess if I'm reading that right, you know, once it's approved by FSA, the approval letter would go to the lender, and then that would be up to the lender to, you know, provide anything to the borrower.
At how many days past due am I supposed to submit my first default status report?
Once the payment is 30 days past due, that's when you submit your first default status report, and then every 60 days thereafter. So once the loan is 30 days past due, that's when you submit your first one.
This next question deals with status reports as well. For regular status reports and delinquent status reports, can you please confirm that lenders need to submit both regular status reports, the March and September, and delinquent ones as needed? They cannot skip the regular status report when the borrower is delinquent. There has been some confusion with those.
Yeah, that's correct. All lenders, no matter the status, are required to submit the semi-annual status reports, the ones that are due on March 31st and September 30th, regardless of the status, because that's how we know what the balance is on the guaranteed loan and whether it's current or behind. Excuse me. And then, yeah, when the loan becomes delinquent, you'll still continue to do these regular status reports. You don't skip those. And then the default status report, you're going to submit your first one after the loan becomes 30 days past due and continue to submit those every 60 days thereafter until you come up with a restructuring plan or you follow through with liquidation that might result in a final loss claim. So hopefully that clears that up, but yes, you do both.
If a guaranteed lender is requesting a partial release for a guaranteed loan customer, what is that process like? Forms, etc.
We didn't cover partial releases today, but that's something, there's specifics on what is required to be submitted for written concurrence from FSA versus what isn't. And so that's something I would definitely suggest you contact your local county office and discuss, but a lot of times we're usually looking for a current balance sheet, an appraisal, depending on what's happening, and then some sort of written narrative. And that would be documents that we would be looking for in the event that you need written concurrence from FSA for a partial release. But you know, there might be more or less depending on the situation of what you're requesting, because some situations don't require written concurrence for partial release.
When an FEL lender does not timely submit or even submit annual analysis on their guaranteed loan borrowers, how does this affect the overall status of the guarantee?
So annual analysis is part of the supervision that you're required to conduct in order to maintain the guarantee. That's something that we're going to check when we come out to do a lender file review. It might be a deficiency that we notate if we see that it's not being completed. If you're not maintaining that guarantee properly, it could greatly affect you in the event of liquidation. And if you're submitting any type of loss claim, adjustments could be made if you weren't monitoring the collateral correctly or applying payments correctly, things like that. So an annual analysis is important because in the long run, if something should happen and you weren't maintaining it properly, we could do deductions on a loss claim. And we would, again, like I said, notate that as deficiencies when we come out to do our file reviews.
This next question is an environmental question. And Matt Henderson, you can weigh in on this one for me. Initial environmental completed with FSA and associated project completed. A new project is being discussed on the same property. Is a new environmental review needed?
Sure, I can take a stab at that. and again, kind of like, a lot of these questions, it really comes down to the specifics of the case. But at a high level, any FSA loan action, direct or guaranteed, requires some level of environmental review. It's just, depending on the project, sometimes that's very simple. Other times it takes a little bit more time. So in a situation like this where, the initial environmental review was completed for whatever the initial loan action was, and now there's another project coming along, it's a matter of, whether or not FSA can leverage any of the information from that initial environmental review for the subsequent one. And again, it's really going to come down to the details of the project. Where is it located? Was, the area that was, reviewed during the first review, does that encompass, wherever this new project's taking place? And like I said, it's just one of those that is always going to vary some case by case depending on the details. But just like I said, as a reminder, we always have to do an environmental review with any loan action. It's just a matter of, how simple or how detailed it is, and, whether or not, we're able to leverage any information from a prior review. But really, that's about the best answer we can give you on that one.
Okay, looks like we got one last question, unless something filters in after this one. Is there any type of funding from the Inflation Reduction Act for guaranteed loans? If so, is there any procedures in place for these farmers to apply?
So the Secretary did announce another round of guaranteed loan assistance just back on October 7th. And as I was talking about status reports, I emphasized that make sure that you're getting your September 30th semi-annual status reports submitted timely, because that is crucial in how we will be making this next round of payments. We'll be providing assistance in the cases where the customer is at least 30 days past due as of September 30th, and we'll be basing it on those status reports. So yeah, there will be another round that, and hopefully letters have made their way to you. We did disseminate those, and hopefully the states have sent letters to you more specifically describing that announcement that was made by the Secretary last week.
Okay, and as always, we will put out a written Q&A after this is over, giving some more depth and detail to some of those questions that were answered today. So you can look for that on the Lender Toolkit link that I had published earlier. And so any questions that were not addressed will get addressed in that Q&A, and you'll have a formal Q&A from today's training.
Okay, well, with that, thank you very much, everyone, for joining us today. Really good questions were asked. Like we said at the beginning, this is going to be recorded. This has been recorded, and the slides will be made available on that link that is in the Q&A chat. So yeah, thank you for attending, and we look forward to working with you this upcoming loan season, and have a good rest of your day, everyone. Thanks.